Hey everyone, welcome to another episode of Mayhem's Macro Monday. Coming to you on Tuesday, September 6th, we had Labor Day off yesterday, and we're going to start the trading week with a theme that I'm calling Into Turbulent Times. Remember, Mayhem's Macro Monday is brought to you by TraderAid.com, where we cover fundamental, macro, and technical analysis. We provide trade ideas, education, interviews, and other insights, and we just launched our Discord server, so if you haven't checked us out, visit us on the web at TraderAid.com. This chart deck is 9 different charts that I had shared on my Twitter account. They got a lot of interest, so I want to talk a little bit more about each one. The first one here is, now that we're in September, it's time to talk about what September means for volatility. It tends to be a more volatile month. We see volatility ratchet up in August, September, and October, and then start to fade as we close out the year. And this is looking at an average of 3 decades of data. While past is not prologue, given some of the catalysts for volatility this month, it wouldn't be too surprising to see it be a rather volatile month. Why? Well, we've got a Fed meeting that could be a 75 bips hike. We've got the acceleration of quantitative tightening to a run rate of $95 billion a month, up to that amount. Doesn't have to be that amount. And that's an increase from 4750 billion. Or 47,500 million from the prior run rate, although the average, according to some research that Aisha had done, was just over 17 billion a month. And that's because the Fed does not have to roll off as much as they say. And she's going to be writing a great article for Trader Aid members about that regarding QT. So look forward to that coming out this week. But suffice it to say, we've got a lot of catalysts for volatility. We also have an increased bond issuance from the Treasury this quarter. They increased 2.5-fold to $444 billion as the Fed is ramping up quantitative tightening. And this is a kind of toxic combination, and we're already seeing it expressed insofar as rates, where rates are starting to go up across the yield curve. A lot of folks are saying get long bonds here because we're going into a recession, but the Fed changed that tune a bit, because they're saying, look, we're going to be distributors of these assets, and the government's saying, hey, we're going to be issuing more of these. So the natural path of price is lower with more supply and less demand. And as a result, you have the underpinnings of the entire financial system, which is the U.S. bond market, looking a bit shaky. The MOVE index has been elevated. The last read that we had on that MOVE index was 120, which isn't the highest that we've seen, but it's not far from the highs. So all of this means it's time to be cautious. The next chart I have for you is stocks remain overvalued versus historical norms per the Shiller price earnings ratio. Now you can see on this chart we're at 29.41. That is significantly higher. The average on this is around 15 to 17. We've seen levels like this, during the dot-com boom. We've seen levels like this during the go-go 1920s. Now, obviously, rates play a role, and that's one of the reasons we were able to achieve such a ridiculously stratospheric PE. But rates are on the rise, and with risk premiums rising, we should see a compression in PE. And it's also likely to happen at a time where we have an earnings recession. So the E may fall as the P falls. We could actually see these ratios looking worse before they get better as a result of that, because if price is falling but earnings are falling faster, price has to catch down, and price has a lot of catching down to do to historical norms. That doesn't mean the S&P is going to 1,000, but it wouldn't be terribly unlikely to see it go below 3,000 if the Fed stays on course with their tightening. Remember, QT is reaching a run rate of $1.1 trillion a year, and they're looking at a terminal rate of 4 or more percent for Fed funds, and they want to hold it there for some time to really squash inflation. The next chart we have here is looking at the S&P 500 in a different light. This is the S&P 500 in real terms, adjusting for US CPI, and we could see it's retraced its entire COVID bull market. Why does that matter? Because we're probably not even done yet. And I think that's the big takeaway here. Inflation has taken away these gains that have been made in the S&P 500, and yet we're probably not even close to done with this bear market. Again, assuming the Fed does what they say they will do, which seems quite likely. And if they do, then that means financial conditions will continue to tighten and higher risk premiums will become more and more likely to provide discounts, especially in riskier stocks, ones that are more rate sensitive, longer duration, unprofitable companies. They will be under the gun. And they have been, but that might not be over. And speaking of companies that are under the gun, tech has been trounced. The largest outflows from tech funds since November 2021. Why does this matter? Because when that happened in November 2021, what followed was a larger leg down. While some might look at this as a contrarian indicator, oh, look, people are dumping their tech, I would look at this as more of a worrisome sign that there could be more to come. And I think that it has everything to do with how rates move from here as to how we can expect tech to perform moving forward. Because there is a pretty strong correlation, it's inverse, between the 30-year rate and the performance of the NASDAQ. And often is the case that bonds see these things ahead of stocks because bonds really are the smart money. They also are the foundation of the market. So when bonds are rattling, stocks can tumble. And we've seen that theme several times this year where, for example, if you plot TLT versus QQQ, when TLT falls, QQQ tends to follow lower. So many of these companies are expensive given the Fed's policy goals and economic environment, which means we could see further discounts, especially with this velocity of selling. We also see retail are up to their eyeballs in stocks. And this is the highest allocation, whether we look at GDP to household holdings of equities or whether we look at their net worth and the percentage that equities compose. This is an extremely elevated level, and typically in bear markets, you don't see a bottom until retail capitulates. And I know I'm speaking to retail. I'm retail too. But we've got to be honest with ourselves. Emotions rule the market. We've had a market ruled by greed for the better part of the last 13 years, and the fear component really hasn't set in yet. And until it does, we probably haven't seen a meaningful bottom. This chart goes to illustrate that point in a little bit more depth. You can see the yellow line showing the S&P 500 total return versus the blue area graph showing household equity flows. And those bottoms are pretty well correlated in the S&P with the dumps that we've seen from households. Why does that matter? Because, again, we haven't seen that dump. And I think we do need to. Especially, again, given what the Fed is saying, they want wealth destruction in order to facilitate their policy goals to reduce demand. They cannot reduce demand commensurate with their policy goals unless they're hitting on all cylinders, which means wealth destruction, which means job destruction, which means increasing the cost of capital to slow the economy. And unfortunately, some of the more leveraged businesses are going to go out of business. This is part of their policy process. And Powell made it pretty clear that pain is to come and they're really have more work to do. We're also seeing another very worrisome sign. As I mentioned earlier, bonds are the focal point of financial markets. The 30-year bond has had a trend, an uptrend since 2000 on this chart, as you can see, and it's breaking down pretty decisively from this trend. This means higher rates. It means lower prices for rate-sensitive and long-duration risk, including tech, growth, biotech, things like gold, silver, Bitcoin, home builders. All this stuff can get in trouble as rates are rising. And rates seem set to rise quite a bit more with this technical breakdown happening, and also with large foreign buyers like China and Japan actually being sellers the first half of this year and not seeing as much bidding so far in the second half. We can also see that large traders, as shown by the red line dipping in the subchart, are actually becoming net sellers again. They are short bonds. And I think it's important to watch their activity because they aren't always, but they tend to be somewhat savvy. We also see Japan's yen tumbling to levels not seen since 1998. This is a big red flag, and it is the foreign exchange market giving the Bank of Japan a vote of no confidence. This fall, the velocity of this fall is significant, and it's amazing because we really haven't seen inflation pick up in Japan too much now. I know it's not all based on currency fluctuations, but for a country that is very dependent on imports and exchange rates, this fall in the yen could start to present a significant problem. And the idea that the Bank of Japan can continue to prop up their bond and equity market just doesn't necessarily seem sustainable. It seems like at some point they're going to have to come around and play defense for their currency before it is worth almost nothing at all. Finally, this chart went all over the place on Twitter. Bull and bear markets over the last 90 years. We can tell bear markets usually are shorter and sharper, and bull markets are usually longer and somewhat slower. Now, this paradigm might be shifting because inflation is becoming structural in nature. And the reason for that is that even though the Fed can destroy demand, and they are, and they will continue to do so, they can't do much to resolve for supply side constraints, and the government isn't doing much to resolve for that either. In fact, they're making it worse with all these spending bills that are coming out. And so you think about it from the perspective of explorers, producers, and transporters. If you're facing recession, higher rates, labor costs are going up, labor productivity is going down, are you going to take a risk and spend money to expand capacity into that kind of situation? No, right? And for the last 5-10 years, a lot of these companies have not been expanding their capacity either. So these problems are becoming more structural in nature. In fact, after COVID and the sort of so-called normalization that we saw in the reopening, utilization of energy has not really resumed to levels we saw pre-COVID. And that's a problem because prices have gone to levels that were much higher. So if we do see anything resembling a normalization of energy utilization, it could portend to much higher prices. The same token applies to other areas of commodities, of raw materials, of agriculture, in the sense that a lot of these prices are likely to come down but still remain elevated above pre-COVID levels. And when the Fed does ultimately pivot, and they will eventually, maybe later 2023 or sometime in 2024 or whenever they break something big enough, they will introduce a new credit cycle. But the problem is because these issues have become structural, because there's not enough supply, when demand comes back, inflation will rear its ugly head earlier during the next credit cycle. And that will mean the Fed has to move aggressively earlier, which portends to shorter credit cycles, more shallow bull markets until these structural supply inelasticity issues are resolved. So I want to leave it there. I hope this is really helpful for everyone that tunes in. Again, this was brought to you by TraderAid.com. We've got much more analysis like this. We just put out our monthly update where we cover what we expect to happen in the month ahead, what we have our eyes on, and so forth. So definitely check us out. Really appreciate everyone's support. If you like this content, please like and subscribe. Check me out on Twitter. You can find me at Mayhem4Markets. That's Mayhem number 4 Markets. I'll catch you next time.